Ladies and gentlemen, if you could take your seats. The next panel is going to be moderated by Greg Hess of Wabash College, president of Wabash College. And he is going to introduce the speakers and say something about our second panel. Thank you very much.
Thank you, everyone. It's an enormous pleasure to be here. As Marvin did, I also want to thank again the Manhattan Institute and E21 for their support in helping to pull together this excellent opportunity for us to talk about what we think are critical questions that undermine the monetary policy health and the financial health of our country. We'll have two speakers that follow me who have papers that are also in your packet. Charlie's going to talk more broadly about reforming the rules that govern the Federal Reserve based on testimony he's given the Joint Economic Commission and other members of the Shadow Open Market Committee have done as well. Second piece is going to be by Deborah Lucas. We're very pleased to have joined the Shadow Open Market Committee. She's going to talk about the value that the GCSEs have received in terms of government support, and to start asking some of those penetrating questions as we think about the overall evolution that Fannie Mae and Freddie Mac are going to need to take in the future. As Diana mentioned, I'm a college president. I don't follow the tick-by-tick ups and downs that's happening in our economy. I do tend to watch Bloomberg from about 6 in the morning to 7 in the morning, which means that I see many of my friends and former colleagues on TV, and I usually take a selfie in front of the TV in front of them and ship it off to them and tell them thanks for the great work they're doing out there. But, and so because I don't get that chance, every day to think about these really penetrating questions, I try to just ask myself, look, I've been kind of gone for about 10 years, and I follow it kind of indirectly, but I just try to ask myself, have we been asking the right questions? We've gone through a lot in the last 10 years, and if you think about it from a higher level, have we actually answered those questions and asked them over the last number of years? And in my general analysis, which you can see in my papers, that I'm not overwhelmed by the fact that we've gone after the biggest problems that were contributing causes to our last financial crisis. I take it that I talk about in the paper that there were, to my mind, three proximate or three, contributing factors. Causation's a stronger word that academics usually are very, very careful to use. But there were, to my mind, three contributors, and including perhaps some others, to the financial crisis. And that legacy is still with us. And I just wanted to ask, are we going after what I think those three big questions are? I think of them as the three Fs. I've been an academic a long time. That's usually not the grade we're looking for, but I didn't call it a grade. And the three Fs, I started by talking about the Federal Reserves. The first F is the Fed, and it had to do with many of the topics that had been discussed by Athanasios and Peter and Marvin, which is, what principles should govern monetary policy decision making? As basically ingrained in our heads, it's hard to talk about the principles of conducting monetary policy in this new age without referring to the great work by John Taylor and his kind of fundamental insight when he talked about kind of a new modern reformulation of thinking about rules versus discretion and how to operationalize that in an interest rate environment as compared to the monetary policy, the money supply environment that we'd had before. And to my mind, as being a longtime member of the Shadow Market Committee, in 2003-2005 period, we were pretty adamant that a period of extended negative short-term real interest rates and a period of prosperity were problematic in the ultimate, as an ultimate monetary policy strategy. And so we complained in the period between 2003-2005 that the Fed was using, at the time, what it was referred to as a deflationary scare to, adopt a policy that was enormously accommodating. We argued that there was a lot of thrust to this policy, which had implications for housing prices and other asset prices. And we think that was a contributing factor. Now, my worry is that And perhaps the cynic in me is that, we are falling into this trap one more time with additional reasons to deviate substantially from a basic policy that we think undermines the health of our monetary policy and our financial system. And that indeed, what the Federal Reserve has kind of found an interesting way to do is to change the debate from rules versus discretion to what I now call rules and discretion, which is that they have adopted a rules-based language to continually change rules from what seems meeting to meeting. And so the rule is changing constantly, and that to me is something that could be underpinned with some of the recommendations from the earlier panel and some of the ones that Charlie Calomiris will very thoughtfully talk about in his paper to come up. The second piece, the second F, and there are a couple of them, so you get a 2-for-1 here. You get a 2-for-1 with a second F, and that's Fannie Mae and Freddie Mac. These were, companies, private companies in those days that had an implicit advantage. And prior to 2008, there were many people who complained that there were logical implications to what seemed like, small advantages that Fannie Mae and Freddie Mac had. I didn't ask John Barry, I meant to ask him earlier, but the Washington Post was all over Fannie Mae and Freddie Mac prior to 2008 for accounting scandals. Remember there's a big accounting scandal there? There was a huge portfolio scandal there. There was an enormous lobbying scandal there. The amount of money, they gave, to support congressional activities was really remarkable. And and they had an implicit advantage. And with small implicit advantages, in financial markets, you can leverage that in so many different ways, from funding sources to, marketing their ultimate products to, the fact that they leverage their portfolio enormously just by buying back their own securities. And this is something that was discussed profoundly beforehand. Now we've taken an implicit advantage and now just made it explicit. It's conservatorship now for it. And the implications of that are still to be seen in our market economy. Housing is growing. It is not rising everywhere in geography. I grew up in California. There it's doing pretty well. Indiana, we're a little flat in terms of pricing. So maybe there's not a uniform change there. But if you think about it from once again, the broadest level I can think about, if you think about the unified government, you right now have that Fannie Mae and Freddie Mac have an even larger share of the mortgage-backed securities market than they've had before, even prior to it, because there's really no there's very little private competition right now for it other than holding it directly on your books, which some areas for some types of mortgages are happening now. But they have huge advantage because they have an explicit guarantee now. They have, we also have the oversight of them are still encouraging, like they did before, to give loans to individuals and families that don't have as much of a down payment as they've had before. The Fed not only is a government entity, Fannie Mae and Freddie Mac, issuing all these securities, but another government entity, the Federal Reserve Board, is buying most of them. And that's an area that people have talked to, not just in what's the best way to think about rolling off the mortgage-backed securities in the Fed's portfolio, but also, the politics of how that could play out. The piece that makes it even more complicated now is that there are payments by Fannie and Freddie that roll straight into the government coffers based on their ownership share of Fannie Mae and Freddie Mac. That makes it incredibly difficult at this point to think of an easy way forward to privatize the housing market again and get, you see in the commercial mortgage-backed securities market, that kind of healed, lots of other areas healed. This one is going to be befuddling, and it won't be trivial. But in this unwinding, I can only try to take from this the biggest lessons I've learned, which is that if you give Fannie Mae and Freddie Mac an advantage on a go-forward basis, even if you think about some hypothetically privatized world, the smallest advantage will be leveraged, right? Once you get some advantage, it's over, because they can use that to bring money in more cheaply and to lend out and to price their securities more attractively. And once you do that, it really destabilizes the overall housing market. Well, I said that we want to ask important questions. Debbie Lucas is going to help us think through an important question, which is, what is the value that we're getting from these, what is the actual value of what's the value of the support that the GSEs are getting from our current arrangements? It's an important question as we think about ways to unwind the enormous presence that the government has in U.S. housing markets. The final F is about financial supervision and regulation. Both Charlie, Debbie, others here have much more expertise in this area than not. I do a lot of listening in terms of what I'm picking up in the world. No matter what you think about Dodd-Frank, about it does a little too much this, a little too much that. One thing we do know is that the politics that are associated with what I call the pitchforks and torches part of every financial crisis is still there. People are still angry. People, and until that anger goes away, it's hard to think very intelligently and very thoughtfully about the best way to improve our regulatory system. And there are good questions that are out there, and they're far better financial economists than me who can answer them. But I will say this, what I've picked up is that there's some ways we can actually simplify financial regulation in ways that can be held almost outside some of these important questions about the Volcker Rule or whether or not we return to Glass-Steagall or not, which are all very important questions. But I'll talk just purely about simplification. The first is that for people who are being regulated, they're looking for a lot more transparency. They feel that the regulatory environment they face is just very black box, and that when it comes to some of the understandings that they work in a very opaque environment. The second is that there's a lot of reporting that goes out to multiple agencies, and that there's a lot of this reporting for each institution is very different. Most major banks are reporting to 4 or 5 organizations, both domestically and with international reach. I think there's a way to simplify that and come to a more standardized approach, and perhaps even in the U.S. reducing the number of that they have to report to, given that the information would then be available for others. We also know that community and small banks are different, and that needs to be recognized, I think, more clearly in whatever regulatory change goes forward. And the other big question that's out there is just too big to fail. There are aspects of that are very attractive to glom onto at first blush. I am a believer, though, that in any market there's going to be innovation, and when there's innovation and somebody's got an advantage, they might get bigger. And it's going to be very hard to legislate in any interesting way to create a market where innovation is rewarded that can satisfy a very simple rule about too big to fail. We can have a broader question on that, but to my mind, there are some big questions out there we need to answer. There are hints that it's starting to emerge now, and Charlie's going to begin by talking about rules to change the governance of the Federal Reserve, and Debbie will talk after that about the GSEs, and give us an understanding of the value they receive from this current arrangement. Thank you very much.
Thanks very much, Greg. And I want to start with just 3 thank yous. One of them is by way of a kind of advertisement. So I want to thank the Manhattan Institute for just having published a new book, which is just released sort of today, called Reforming Financial Regulation After Dodd-Frank. And I won't talk about that today, but I will talk about it, I hope to talk about it, at our next SOMC meeting. Second thank you is to John Williams for coming. Not only is John one of the most brilliant and forceful advocates within the Fed system for good monetary policy, but he also is balancing us today because every member of the SOMC is from an Eastern time zone. And so we finally have somebody here who's not from an Eastern time zone, and welcome to New York. And my third thank you is to Debbie Lucas, who just joined our club here, and we're thrilled to have her on board. So thanks for coming and joining us, Debbie. I want to talk about structural reform at the Fed. Actually, the paper that I circulated has a lot of different parts to it. I'll mention those parts. And I also want to recognize that many of the ideas in that paper really came from some notes that Greg and Athanasius and I worked on together at congressional testimony. Right now, I don't know how many of you have thought of this. I'm guessing most of you have. 2 years from now, we'll have an entirely different Federal Reserve Board, appointed by our current president. Furthermore, that new president who will appoint those new governors also is sitting at a time when, during that period, when he'll be appointing them, he has Republican control of both houses of Congress and therefore approval. And as you know, we also have changed the Senate's rules about approval. Furthermore, we also have a major act that just got out of committee yesterday called the Financial Choice Act out of the House that has some pretty interesting things in it about the Fed related to some of the things that happened in our first panel and also some of what I'm going to talk about. And so it's important to sit here and realize that this is no longer an interesting hypothetical conversation that we're having about the structure of the governance of the Federal Reserve System. And I'll come back to, at the end, to talk a little bit about what I think how the politics is very interesting right now, because I think it's actually, believe it or not, a wonderful opportunity for bipartisanship coming out of the concentration of control in the Republican Party right now. So stay tuned, I'll come back to that. So let me start with history. As historians of the Fed, such as Alan Meltzer, have been noting for many years, the Fed has failed to achieve its central objectives of price and financial stability during about 3/4 of its first 100 years of operation. And when Meltzer and others try to explain that, they point to two deficiencies at the Fed that have been primarily responsible. First, adherence to bad ideas. We should not discount this. Especially susceptibility to intellectual fads, which in retrospect are regarded as wrong. It's not just sort of changes in model parameters, but whole ways of thinking about the world that people were absolutely convinced were correct at the time, which we now are absolutely convinced were wrong. That's the main reason the Fed has failed. Second main reason is politicization of the Fed. Which has led it to purposely stray from doing the right thing, you might say, because of political influences. And so the failures to achieve price stability and financial stability for the last 100 years have mainly reflected these two deficiencies. So if we're going to sit around and talk about how do we make the Fed work better, we have to first take stock of this is why the Fed fails. Unfortunately, the problems that we're talking about are not merely a matter of history. And I would say that the same problems that Meltzer and others have pointed to, bad ideas and politicization, now as before, are driving factors of likely future Fed errors. So I want to talk about three types of reform. In the paper, I talk about three. Governance reforms that focus on the structure and operation of the Fed. Here, the main goal is how I'll argue, to decentralize power within the Fed and to promote real diversity of thinking. A second area, which the first panel spoke a lot about, is policy process reforms that narrow the Fed's primary mandate to price stability and that require the Fed to adopt and to disclose a systematic approach to monetary policy, which would promote transparency and accountability of the Fed, also reducing risks associated with unknown monetary policy and making its actions wiser, clearer, and, we didn't mention it, more independent, because really one of the main outcomes of the Fed being systematic and having a primary price stability mandate is that it protects the Fed from political influence because it provides cover for the Fed when the Fed leaders have to testify before Congress. And three, other reforms, which I'm not going to talk much about, but they're in the paper, that would constrain the Fed not to act as a fiscal authority, that would constrain its asset holdings, its activities, to avoid involvement in areas that are either outside of its realm of involvement or that themselves are actually conflicts of interest that undermine monetary policy effectiveness. So unfortunately, I won't have time to talk about that, but my paper does. So my paper ends up making 17 specific proposals. You'll be glad to hear I won't go through all of them. I'll only have time to discuss that first category of Fed governance reforms. So I want to begin by pointing out that a major driver, I think, is that we have to make the Fed more institutionally democratic and diverse in its thinking. And by doing that, we make it less susceptible to political pressure. Remember, we have two problems here. One is political pressure. Why? Because centralization of power in the chair of the Fed invites more political pressures on the chair. I won't tell gossipy rumors about Washington about secret backdoor or closed-door meetings that have recently been purported to have happened between a particular member of Congress and the chair of the Fed that have resulted in particular political pressures that resulted in a specific action. I won't refer to that in detail. But I will tell you that everyone in the Federal Reserve knows exactly what I'm talking about, and everyone in Congress knows exactly what I'm talking about. The fact that you, the American citizens, don't is really interesting. So yes, giving the chair that much centralized power invites political pressure, invites Congress people to meet with the chair and make a deal. And that just happened, and it happens all the time. Secondly, it makes the Fed less likely, if we diversify the power in the Fed, it makes the Fed less likely to adhere to bad ideas because there's reduced likelihood of groupthink. So let's just also point out how centralized power has become at the Fed. In recent years, there's been an unhealthy increase in the centralization of power that has two parts. One is the power of the Fed chair over the Federal Reserve Board, and the other is the concentration of power within the Federal Reserve System at the Board of Governors. Dan Thornton and Dave Wheelock, both at the St. Louis Fed, went through the history of voting in the FOMC, and they showed that in recent years, that is in their paper, 1995 to 2014, there were only two occasions, two votes, in which governors dissented from what the chair voted. That compares to 65 dissents during the same period by Federal Reserve Bank presidents. That's interesting. Furthermore, both presidents and governors had a similar healthy pattern of dissents from 1957 to 1995, with about 8 dissents per year for each of those two groups. Surely, a well-informed and diligent group of 6 independent non-chair governors could find some reason to disagree from time to time with the chair. Federal Reserve Bank presidents still find the capacity to disagree. Supreme Court justices do. Members of the committee at the Bank of England do. Federal Reserve governors used to, but somehow they've forgotten how to. And by the way, I went back, I just happened to be rereading Mariner Eccles' testimony to Congress in 1935, where he was basically framing his proposals for what is now the current structure of the FOMC. And what's so ironic is, what was his argument for limiting Federal Reserve Bank presidents' voting rights at the FOMC? His argument was he was worried that a thin majority of Federal Reserve Bank presidents could overturn a thin minority, could ally with a thin minority of governors. In other words, he was taking for granted a lot of dissent in the Board of Governors. That's why he wanted to limit voting power of the governors. Not a problem anymore, Mariner. We don't have that problem anymore, so you'll see where I'm headed, among other things, with the voting rules. Okay, so there are 3 explanations for this. One could be that the governors are get-along-go-alongs, and there are appointed as get-along-go-alongs. A second possibility is they're short timers, because they all are, pretty much. And so if you're a short timer, rather than the original design of 14-year appointments, everybody goes for a year or two now. So if you're there for a year or two, why make trouble? Get out, get your appointments to all these lucrative boards that you're going to sit on, and just get along, go along in the meantime. Why fight it? A third possibility is that the governors lack the information or background needed to actually make decisions. Well, that's a pretty good possibility, too, because the chairs don't have any staff. The non-chair governors don't have any staff that reports to them. So, of course, how can they have an independent opinion in this very complicated world? Whereas the presidents do have research staff, and the chair has the entirety of the Board of Governors research staff. And, of course, many governors, including Alan Blinder, Larry Meyer, complained about this. Note that if the chair of the Fed tells the staff of the Federal Reserve Board not to speak to governors, they will not speak to the governors. And it used to be, it's all very discretionary. Now they can speak to the governors, but it didn't used to be that they could, and at any moment they could once again be forbidden from speaking to them. So not only is there that disturbing power imbalance within the board, there's also been a shift of power within the system towards Washington. So throughout the founding and operation of the Fed, it's been recognized that the Board of Governors is more attuned to political pressure than the Fed presidents. The presidents, therefore, play a crucial role in deterring political influence. The shift of power, though, toward the board has made it harder for Federal Reserve presidents to really be independent or to challenge the chair, and has served to further politicize the Fed. One symptom of that shift has been an increasingly aggressive approval, in quotes, process by the Board of Governors for nominees to be presidents of the Federal Reserve banks. So it used to be, and it was, if you go back to that 1935 testimony by Eccles, the idea was it was supposed to be an approval. The presidents were appointed by the banks with the approval of the Board of Governors. It's now turned into the Board of Governors tells the Federal Reserve Bank which person to appoint. Now, there may be some latitude, but it is an advance approval. What do you call advance approval? I don't know. My knowledge of the Stalinist regime tells me it's called dictatorship. So although this discussion of this issue has been limited to those within the system and some informed journalists and academics, recent presidential searches have purportedly resulted in the non-approval of multiple finalist candidates put forth by the reserve banks, and sometimes the proactive suggestion of who needs to be appointed. Now, in addition to the problems of excessive centralization of power, there's also been a cultural shift in the Fed that's reduced the diversity of thinking in another way and made the Fed more susceptible to academic fads. And that is basically the dominance of academically trained macroeconomists in Federal Reserve leadership. Of course, didn't used to be the case prior to the 70s. There's still some diversity, but not nearly enough. So what can we do about, well, first of all, remember, who's your favorite Fed chair of recent years? Well, many of you would say Paul Volcker. Many view him as the most successful chair in recent decades. And it's noteworthy that he rejected the model-driven advice of many Fed economists who were adhering to the Phillips curve at that time when Volcker didn't. People like Volcker, who took macroeconomic modeling with the appropriate large grain of salt, whose spine was stiffened by years in the trenches of global banking, and who deeply understood the psychology of financial markets, are unlikely to end up as leaders of today's Fed. That fact would not have pleased the Fed's founders. The structure of the system, as originally conceived, was meant to balance, and as reformed in 1935, was meant to balance political appointees on the governors with banking experts, not just business experts, not just citizens, but people who really knew the financial markets. Academics were largely absent from the Fed until recent years, and the reason why we have a system of 12 Federal Reserve banks was intended to ensure that Fed leaders would be guided by the different circumstances of their regional banking systems, meaning their financial markets and banking systems. But we don't really have that voice now. So we still need people other than PhD macroeconomists at the Fed, people who bring a variety of facts and thinking to bear on economic questions. There's no better antidote to Fed groupthink than having FOMC members who are willing to scoff at economists' certainties, especially if their own experiences provide credible alternative perspectives that they can share about how markets and people behave. How can we construct new rules for the Fed leadership that will reduce the centralization of power, enhance thought diversity, and reduce groupthink risk? So I have a list. I'm just going to go through them quickly. How much time have I got left? Have I already overused my time? A couple more minutes, okay. So Congress could require at least 2 of the 7 Fed governors to be people with significant financial markets experience. So let's have 2 people like a Peter Fisher and a Kevin Warsh. To further build diverse thinking, the power of the chair should be limited. For starters, to ensure that governors have access to necessary information, let's let each governor have 2 independent staff members that work for just him or her. Perhaps that reform would also help solve another problem, the short tenure of most governors. Although their terms are 14 years, most leave after 2 years. Before governors become fully educated to the intricacies and challenges of monetary policy, they're on their way back to the universities where they came from to avoid losing their chaired professorships, which they didn't resign. They went on leave. Congress should require governors to resign their other positions, including university professorships, as a condition for appointment, and also ask them to pledge that they expect to stay on as governors for at least half of their appointed terms. Salaries and retirement benefits for governors need to be increased to ensure that the Fed, when doing all that, remains able to attract talented people. Part of the reason that governors return to academia so quickly is that for most of them, salaries as governors, and by the way, pension benefits and health benefits, are less than what they might get at universities. In addition to reforming the Board of Governors, Congress needs to increase the role of Federal Reserve banks within the FOMC and increase their independence within the system. Again, simple ideas can fix this. Federal Reserve Bank presidents should be selected based on their independent decisions and should no longer be subject to the approval of the Board of Governors. Congress should change FOMC voting rules so that all Federal Reserve Bank presidents vote at every meeting. That would promote diversity by giving more power and voice to the research staffs at the Federal Reserve Banks. Perhaps most importantly, the 12 Federal Reserve Banks should also be freed from the budgetary control of the Fed board and its chair, who use budgetary power as a threat to gain cooperation on policy matters. For example, the Federal Reserve System could establish a committee comprised of representatives of all the Federal Reserve Banks and the Board of Governors, and perhaps even some outsiders, to consider the budgets of the bank and the governor's staff. It would further promote diversity of thinking if Federal Reserve Banks were prohibited from appointing Federal Reserve Bank presidents from within their own bank. Fine to appoint from another bank. Why? Because that encourages a little bit too much unhealthy inbreeding within each of the banks. Now, those are some basic ideas. There's some other good ones I'm sure we could all come up with. But what I want to emphasize at the end is, this is a time when I think these kinds of ideas might actually have a lot of appeal to Democrats. Why? Because Donald Trump is about to appoint 7 governors with an approval process that's going to pretty much give him who he wants. So maybe if you were a Democrat in Congress, this would be a good time to be thinking about procedural reforms that would produce real diversity. Thank you for your attention.
Yeah, I neglected to take a few questions, but maybe it's a good time now to take a few questions for Charlie, for me, and then we'll move on to Debbie. Please. Are there any questions out there? Please. Yeah, you were first. Yes, sir. The mic's right there.
I'm Michael Myers. I'm president of the New York Civil Rights Coalition. What's the other side of the democratization of the Fed? I don't like what you just said. I like the chair being powerful. I like the chair having staff. I don't want to be on the Fed if I were a member of the Fed. I don't want a Fed where you have everybody got their staff and they're going to have meetings and people arguing this and arguing that. I want to get in, get out. I got a job to do. I got other jobs to do. That's not the role of the Fed. So what's the pushback? And Donald Trump, if you say Donald Trump will appoint 7 people, if it's only for 2 years as opposed to 14 years because they're going to get out and do their own jobs, what's wrong with that? That's democracy. The better side of democracy, as opposed to arguing all the time.
So my view is that the whole point of having more than one person, if we just want to have one dictator at the Fed, then let's get rid of all this window dressing, right? But if we really believe, as I do, that we need diversity of opinion and that we need real democracy at the Fed so that we can represent diversity of opinion, then I'd like to make it real. But if the Congress agrees with you and they don't really want that diversity, then let's just have one person run it and quit with all the window dressing. Next question.
Please, yes.
Thank you. So, Krishna Guhar, Evercore. Charlie, you made a very sophisticated argument in terms of strengthening the diversity and the ability of people to present different perspectives within the Fed system. I find this a little hard to square with what I believe is your support for a single rules-based policy. It would seem to me, at least on the face of it, that there's some tension between the value that you put on diverse thinking, different staffs, different models, and then chaining the committee to follow a single rule. Now, you clearly don't see a tension there.
Not at all.
Can you explain, but you see
Sure.
the apparent tension. Can you explain how you
Right.
unpack it?
So very, very simply, let me point out the first part of this paper basically goes through and agrees with everything that the 3 first panelists said. So then what's the point of diversity? It's to debate, assuming that the FOMC is going to be revising from time to time, as Athanasius pointed out, what its rule or systematic approach, whatever you want to call it, is going to be. We want to have diversity of models and views on that, and diversity of worldviews, too, that can inform that. Even some people who may not be modelers will at least have some healthy skepticism about what's being left out of some models. So the point is, as I envision it, the point of the FOMC under a reformed Fed that would adopt price stability as its primary mandate, primary goal, and then cyclical stability as a secondary goal with a particular well-designed systematic approach. The main point of the FOMC is to discuss and debate how to do that and to revise it accordingly so that they go together perfectly.
Please.
Hi, Mike Weinberg, Protege Partners. Do you have a view on GSE reform? If so, what is that?
I'm going to leave the GSE topic to my colleague Debbie Lucas, but in the book that's handed out, I have a lot of discussion of GSE reform. I've been writing about GSEs for now 23 years, so I'm happy to discuss the topic, and at the next meeting, I'll be talking a little bit more about housing more generally, I'm hoping to, and why I think that we have such a deep political problem with the subsidization of mortgage risk in our society. But I want to leave, I don't want to steal any of Debbie's thunder.
We'll circle back that after Debbie talks, and she'll give us a framework for understanding and putting some numbers to some pieces of it. Please. And last question, one more question. Yes, please, Anne Marie.
One thing that I have a lot of sympathy with getting the power of Washington reduced, but I keep thinking the period of the 70s was a particularly bad period, and there was a lot of dissent during that period. And yet, it didn't prevent the fad of the time, which was a Phillips curve view of the world that inflation helps growth, didn't seem to get offset, despite the fact that there were people, particularly in St. Louis and a few other feds, that argued it at every meeting, but it didn't change anything.
I remember that there are two legs that we're standing on for Fed errors. One is politicization, and the other is bad models. And I think if you look at the 70s, the two are feeding each other. I think Arthur Burns, sorry to have to say this about a Colombian, Arthur Burns was clearly one of the most politicized Fed leaders in its history. And when you want to have an outcome, you can also find a convenient model that supports it.
All right, thank you very much, Charlie. We'll now have Debbie Lucas, please.
I want to start by thanking the SOMC for inviting me to join them and deeming me worthy of such an interesting, really debating society. So it's a very comfortable place to come into, because I think that the kinds of questions that we're dealing with are difficult and they will never really be answered. And so the kind of the quest to keep on revisiting them and being brave about saying things that not everyone is saying is a worthwhile goal. So I was very honored to be asked to join that group. What I'm actually talking about today, which is valuing the GSE's government support, isn't directly a topic that would necessarily interest people who are focused on Fed policy, but I'm going to try to make the case that these kinds of valuation issues that I want to focus on are actually extremely relevant for all government policy, not just the GSEs narrowly. Also, obviously, there's a lot of interaction between the GSEs and the Federal Reserve, not only the fact that right now the Federal Reserve is holding so much GSE MBS in their portfolio, but more broadly, the channels of monetary policy, at least as it hits households, goes largely through the mortgage market. So the whole way that we move forward with the mortgage market will certainly have implications for the way the Fed thinks about the channels of monetary policy. So, so just to get to the substance of it, I'm going to focus, as I said, on valuing the GSE's government support through commenting on the answers to 4 specific questions. The first, what was the cost of the federal bailout of the GSEs? Has that cost been recovered? What's the value of the current and continuing federal backstop of the GSEs? And then finally, would privatization cost money or make money for taxpayers? So those actually turn out to be hard and contentious questions. So let me just first say a few words on why I think valuation deserves more attention, both for questions of how we go forward with the GSEs and generally. With the GSEs, whatever reform proposal is ultimately adopted, there's a general sense that the goal is to bring more private capital into what is now largely a governmental mortgage market. Therefore, it's pretty clear that any reform proposal that gets implemented is going to involve massive transfers of risk and resources between the public and the private sectors. Just for example, there's the balance sheet assets of Fannie and Freddie. If they're sold, there's a big transfer. But probably more importantly and more subtly, in most systems that are envisioned for the future, there may be some residual explicit guarantees that are going to have to be priced and their risks evaluated. And also there's a risk always, or I don't know if it's a risk, but there's a reality that if there aren't explicit guarantees, there will still be implicit guarantees. And so we also want to think about that. So I think clearly unbiased valuations are essential for transparency, for objective policy evaluation, and for taxpayer protection. And somewhat surprisingly, I think, when you look at a lot of things, you see very few attempts to actually put values on things to evaluate costs. This is a concern not just for fiscal policy, it also applies to regulatory policy and even to monetary policy. As an economist, it has always seemed to me that one of the great things that we offer the world is the ability to do some kind of cost-benefit analysis, because that puts some hard numbers on things. In a way, it's not that I think that the outcome is so important, but like stress testing of banks, I think that the value is in what you do as you're coming up with that cost-benefit analysis, because it forces you to think about things more deeply. Well, you can't do cost-benefit analysis without numbers. I think for fiscal policy, the idea that you need numbers is pretty well established. And actually, for regulatory policy, under current law, federal agencies are supposed to perform cost-benefit analyses. Independent agencies, however, have not yet been required to do so, though a lot of them have started to move in that direction, perhaps seeing some of the writing on the wall. Certainly the Federal Reserve is an example of an independent agency where, in my view, putting more emphasis on creating hard numbers of the costs and benefits of the regulatory policies is a place where there could be a big return. But let me circle back to the GSEs and say that in the case of the GSEs, there's a lot of challenges to putting numbers on the costs involved. One is just there's a complexity in valuing the kinds of contingent guarantees that they offer. The situation is complicated by the fact that the current budgetary treatment of federal guarantees is at odds with the economics of valuing those federal guarantees. So the confusion or the difficulty to begin with is multiplied by the disconnect between government accounting and reasonable accounting. But then finally, and what I want to focus on is there's not even a conceptual agreement on the meaning of cost. So let me go into, I'm going to get to that in a second, just so that we all are on the same page in terms of what happened. Let me just take a second to talk about the situation with the GSEs since 2008. So as the financial crisis was unfolding, it became clear that financial markets were getting nervous about the GSEs. The spreads that they had to pay to raise funds were starting to widen. And the fear that the market would panic about providing money to the GSEs would collapse the mortgage market led to the passage of the Housing and Economic Recovery Act of 2008 called HERA. What did HERA do? First of all, it placed the GSEs into federal conservatorship. Effectively, it created an explicit guarantee on the securities issued by the GSEs. It did it through a mechanism called senior preferred stock purchase agreements, whereby the Treasury was authorized to purchase enough preferred stock from the GSEs to ensure their solvency. The law capped the total draws at $455 billion, of which there's $258 billion left today. In case you're wondering, how big is that $258 billion, and would it last them through another financial crisis, I'll say that if you stress test the GSEs, it takes an extremely rare event to blow through that $258 billion. So the markets treat them now as being fairly risk-free, and so that's not a big concern. However, something else that happened with HERA is it stated that these preferred stocks would be paid a 10% dividend. A 10% dividend is greater than the earnings of the GSEs typically, and so that put them in a situation where they were in fact paying that 10% dividend, but it was being funded by the Treasury. And so there was kind of circular payments that were drawing, and so the circular payments had two bad consequences. One is they made it completely confusing as to whether the GSEs were making money for the government or costing them money. But beyond that, they were causing this finite line to be drawn down, leaving less capacity for protection in the future. That resulted in what's been called the Third Amendment to HERA in August of 2012, which replaced the 10% dividend with a simple sweep of all Treasury profits into the Treasury. So basically now they sit with zero balance sheet equity, but if there's ever a negative blip, Treasury tops it up by putting in more preferred stock. Okay. Okay, so let me swing around to the question of what's the value of the federal bailout and whether that value has been recovered. The kind of naive analysis that you see in the press and that some people like because it's simple is to simply add up all the money that was paid from Treasury to Fannie and Freddie and compare that to the sum of the money that they've paid back to date. The bottom line of all of that is by that simple summing of cash flows measure, Fannie and Freddie have paid back the money that they received. On net, Fannie Mae has returned $31 billion to the Treasury, and Freddie Mac has returned $27 billion to the Treasury. So some people conclude, okay, we're done. We don't owe you, we owe nothing anymore. So there's a few problems with that naive analysis. The kind of simple one is it neglects any sense of the time value of money and any kind of risk premium. And so the very simple kind of, that's simply dealt with. And say that you discount all those cash flows at 10%, which is the value or the rate that was promised on the dividends. Doing that, in fact, you flip what looks from being fully paid back to still being a bit in deficit by about $9 billion collectively between Fannie and Freddie. However, I don't think that even that corrects the misperception of net cost, and I want to spend a little time on that. So really, what was the cost? How should you think about the cost? Well, I would argue that an economic notion of cost is always an ex-ante idea. It should be the value of the assistance that was granted at the time that HERO was passed. That is, it amounts to what a private insurance company would have charged for writing a contract, a firm contract, that provided that level of protection. So basically, I'm arguing that the value should be a forward-looking, fair value kind of concept. And in fact, that calculation was done by CBO in 2010, where they looked at the value of assistance that had been paid to that time, and also the value of new guarantees in 2009. Their fair value estimate was that the total cost was $291 billion, which by any measure still leaves over $100 billion not returned. Okay, so that ex-ante kind of idea takes into account the fact that at the time when these guarantees were made, there was some probability that things would get worse and not better. In fact, just adding together cash flows reflects that we are in a period where luckily things have gotten better, and that's great, but that's not a reflection of cost. That's a reflection of ex post outcome. So it's very important to think about that properly. So the conclusion that I'm coming to here anyway is that they have not fully paid back the government. What about the value of the continuing Treasury backstop? So we still have these preferred stock agreements. The GSEs still effectively are guaranteed by the government. What's the value of that ongoing protection? Recently, I've been returning to some old models, which I used before the crisis to say that Fannie and Freddie were very expensive when we were lambasted by everyone on both sides of the aisle in Congress for saying that. But in any case, those same models can be used to look at the ongoing cost of Fannie and Freddie. Or to put it differently, is the value of the sweep that is currently going on of Fannie and Freddie's profits to Treasury more or less than the value of the insurance that they're getting from the government? My analysis is a little preliminary, but I would say that roughly it's a wash. So it isn't that Fannie and Freddie are that profitable beyond the value of the insurance that the government is giving them. Okay. So with all of that, let me turn to the question of would privatization cost money or make money for taxpayers? Obviously, this is going to depend on the specifics of any reform proposal. But what I've tried to convince you of so far is that so far, the taxpayer has not been made whole. And furthermore, at present, these companies are not particularly profitable over the cost of the risk that they're assuming. Beyond that, their systems are aging. It's not really clear what their going concern value would be unless the government goes back to the bad old days and underprices government guarantees, or restores something of duopoly power that protects them from market forces in the market. So my belief is that under any proper measure of the cost of privatization, it shouldn't look like they're making money for the government. If it does look like they're making money for the government, it's either bad accounting or giving away resources at less than their value. I don't want you to take this as my being personally against moving to a more privatized mortgage market. In fact, I deeply support moving towards a more private market. It's just, it's just a warning that we need to agree on what things cost in order to move forward and to have a clear idea of what the government is giving away and what it's getting in return. So I'll leave it at that. Thank you.
Well, that was terrific, Debbie. Thank you so much, Debbie. Thank you. That was terrific. Are there any questions? Some provocative statements there? Questions, thoughts? You asked an earlier question about GSEs. Do you want to, in light of Debbie's comments, do you want to reframe it or at least restate it? Let's get the microphone.
Can you hear me?
No, we need the mic.
Yeah, sorry.
I guess my questions are, in light of that, what are the alternatives? What do you recommend? What are the alternatives and what do you recommend then?
So that could.
You want to pull it a lot closer.
Yeah, pull it a lot closer. So I've obviously thought about that quite a lot. Interestingly, there has been quite a lot of convergence in the leading reform proposals, and I would say their basic nature involves shifting first losses to the private sector, pulling back quite a bit. I think there's some hidden disagreement about how much, but pulling back quite a bit on government guarantees, moving, as was discussed before, moving the affordable housing goals perhaps more completely into the FHA and other federal agencies and putting them on budget instead of doing it indirectly through mandates on the successor entities. There's a debate among this class of proposals about whether to have securities that have some residual government backing going through something that looks more like a public utility or a central entity, or somehow, recreating a Fannie Mae-ish thing, which is where the government ones come, and maybe letting some private firms somehow compete around the edges. Because of the political economy of the situation, I strongly propose not doing that. I would really like to see Fannie and Freddie taken out back and shot in the head, because I mean, this is so liberating, because every job I've ever had,
Go ahead.
I never am allowed to give my opinion, but this is just my opinion and not of any agency I've ever worked for. The reason The reason I feel that is because I feel like any residual government guaranteed entity or clearinghouse, or what you want to call it, is just going to be a magnet for continuation of the housing lobby having a very clean place to put their effort. So I think actually the U.S. can learn a lot from housing markets in other countries, which now have rates of home ownership that are equal to or exceed ours, and they're financing mortgages largely through their banking systems, often with covered bonds. But I feel that kind of a structure isn't immune, of course, from political pressures, but at least it doesn't carve out the housing space into this kind of dedicated place where you can pile on gradually over time, again, all kinds of regulations. So I would like to see a structure where you let private entities come in. There's no reason that Citi and B of A and everyone else can't do securitization if they meet certain standards. Perhaps they can have this government guarantee backstop. I would lower the size of the conforming limit. I've gone on way too long, but that's kind of an outline of my thoughts on the topic.
Please, Diana, please. Yes.
Oh, just a very quick follow-up question, Debbie. When you talk about other countries and their home ownership rates, in some countries it's harder to sell houses than it is here in the United States. And one advantage of the United States system is that it's pretty easy to sell your home and move, which is less easy in some countries. Would you be able to comment on that? Not, of course, that I'm in favor of keeping Fannie or Freddie in any way or shape or form, but just for the comparison's sake.
I think I'm going to not, because there's better and worse systems, and there's government support for everything in Europe, including the housing market indirectly. So I think I'm just trying to make the point that we should be looking beyond our own borders for better models and try to understand how the risks are being shared in the kind of political economy things, as well as mobility and other important issues.
Let's go back there. There are a couple side by side. I'll let you two sort it out.
It bothers me very, very deeply that what the system as it is encourages banks, private banks, to finance the mortgage market, take a risk of financing any mortgage, and then securitize it, which means give it over to Fannie Mac and Freddie Mae, which means that we're going back right into the bad situation again. It seems to me that we should not. We're essentially having a market that is really should be federal FHA, and we're financing people buying homes who can't afford homes because Fannie Mac, the banks will then give the mortgage to Fannie Mac and Freddie Mae.
Well, I think one of the things that Debbie pointed to and others have said that, if we're going to make those types of encouragement to encourage loans that do create stress, we find another vehicle to do that, either FHA, which would be separate, or if the government has an interest in subsidizing housing, they should write a check and subsidize housing rather than find kind of a backdoor, less costly way that doesn't flow through the books. And obviously, once the government has to start writing checks, that's going to make it a lot, less willing to actually do it. But obviously, if they're going to do a subsidy, they should write the check. Ultimately, her point is that there is a dollar cost to this, and the best way to know that is force the government to write the check for it. Please.
Yes. In a democratic society, under what statute does the government allow itself to take over two private companies?
They were not just private companies. They were private companies with government charters. In fact, Fannie Mae was a child of the Great Depression. It was part of the government. It was privatized actually for budgetary reasons because the government wanted to get it off its books. But certainly it's always had a charter that gives it special rights and special responsibilities. Long before the bailout, it had things like a line from the Treasury. It has, in fact, a mission of making credit widely available. It was it has, so they are by no means private companies. I realize that there's a lot of money at stake and that my answers are not very sympathetic to the private equity holders who still believe that they have a stake in the companies. I think it's a little unfortunate that they were put in conservatorship and not receivership, because that would have kind of cleared it out. By any measure, in my view, they were dead as a doorknob financially, but I fully respect the courts and everyone's right to duke it out. But in terms of the economics of the situation, I don't think there's any merit in the claim that somehow private shareholders, in an economic sense, are owed anything. But again, there's these legal issues that are beyond my knowledge to comment on.
Please over here.
So I thought your analysis of the cost of what was given to the GSEs and what was taken out was very insightful. And I was glad to see it because there's been a lot of analysis that talks about whether the government should be a part of housing, but at the end of the day, sort of valuing the money is a useful exercise. Based on what you said, much of which I agree with, it seems like what the government is providing to these entities right now is, and the form in which it is stabilizing the US housing market, the Federal Reserve's balance sheet, because let's face it, the Federal Reserve owns 1.7 trillion of these things, and God forbid there might be an issue with agency securities maybe yielding 5% tomorrow. So the form of support is a $258 billion credit line. And based on what you said, it takes equity line. Yes, it's a $258 billion letter of equity commitment.
Right.
And
if that's not enough, there'll be more.
Yeah.
well, but that's my question. So my first question about the 258 billion is, let's say we need 20 billion tomorrow because there's housing reform and the deferred tax asset comes back in. There's 20 billion coming out of the budget, and oh, by the way, we have a debt ceiling issue. Where's the 20 billion coming from? And then the other question that I have is, if it's 100 billion, can the debt ceiling support it? On the other hand, if you replace the 258 billion with an equity commitment from a private entity, wouldn't that stand in place of the federal government so you don't have the debt ceiling issue? So that's my first question. And then the second question that I have.
We'll give you part B. Let her try part A.
Let me just mention, on the debt ceiling, the GSE's debt is not counted under the debt ceiling, so it's just not there's not an issue between the debt ceiling. So which, I guess, are you asking if there was
A draw.
draw on the line and it would be on the margin funded by more debt? Yeah. That's an interesting issue. I don't think people have really looked at, in general, whether a financial emergency that was in the short term funded by debt would blow through the debt ceiling and what would happen in that case. So it's an interesting issue that I think is interesting, but not the first order thing here. I think it's unlikely that they would get a large draw in the current situation.
Okay, follow up, please.
I estimate that if they get tax reform done, which we can debate whether they do or they don't, there is a Republican House and Republican Senate, but every Republican has a different opinion, so who the hell knows? But if they do get tax reform done, there will be an immediate draw because the deferred tax asset has to be returned.
Oh, I see. That's interesting. I'll look at it.
But my other question is, so let's sort of do a hypothetical where we replace the 258 billion of equity commitment from the federal government with private capital. Now, that private capital is not going to come in if you have a situation where you can change the rules of the game at will, where you can put in a network sweep or not, right? So you have to have some clarity about on what the terms of the game are going to be.
So on that one, I think just 258 is just not the relevant number because that was the result of wanting to do a one-time deal with Congress, which was big enough to get you through the crisis and anything that came after that. And Congress had no intention of revisiting it for a long time. And in fact, they probably still don't want to revisit it for a long time. And it's accommodated that. But the question of how much private capital would you need, I think it's a smaller number than that. But beyond that, what the argument I tried to make is that private capital can come into the mortgage market, but I don't think it makes sense for it to come in to Fannie and Freddie so much because, why should it come through Fannie and Freddie? I've been arguing that you have this kind of shell of these entities where you'd be better to liquidate their assets. Why should the government be intermediating the reinfusion of equity? They can set capital requirements on banks, for instance, that deal in these securitized mortgages. But it never really makes sense to me, these proposals to directly recapitalize Fannie and Freddie. This is why I said take them out back and shoot them, which does not involve recapitalizing them.
Well, the intellectual purity requires liquidating them, which, by the way, would address the issue of the property rights of the private preferred holders.
That's right. It would.
But unfortunately, the reality is the Federal Reserve owns 1.7 trillion of these securities. If you start liquidating these entities, I mean, I would be interested, sort of, there are more informed people here than I am, what might happen to I guess, the Federal Reserve more than anything else.
We could get a swap organized, I think, as part of the GSE reform. That wouldn't be, I think, an issue we couldn't overcome.
Okay.
The outstanding assets could also continue to be guaranteed, so it could be just clarified that there were no credit issues with what's already outstanding. It's more of a going forward issue.
Just being mindful of time, let's take a question over here. Thank you.
A very interesting talk. In 2008, the Wall Street was holding hundreds of billions of dollars worth of securities backed by subprime mortgages, and the Fed went out and bought hundreds of billion dollars worth of mortgage-backed securities, and suddenly Wall Street didn't have any problems anymore. So to what extent are the Fed's holdings of mortgage-backed securities backed by these problem subprime mortgages, and how are they, is the Fed taking losses on them, or are they not?
So it's important to understand that in the mortgage market, the risk of all these government-backed securities is on the fiscal side. So subprime has largely migrated to FHA and VA and the Rural Housing Service. So there's been, actually you can see that there's been this contraction of the private subprime market, but to the extent that it's moved elsewhere, it has been to the government. But it's on budget from the things. That doesn't make it right or wrong, but I'm just saying that the Fed doesn't bear that credit risk because another part of the government has already taken on that credit risk. So the Fed has no exposure to that subprime risk. Whether these are a good idea is a different question.
I always had the understanding that the Fed was mostly in new issues, and that and as the Fed ramped up its purchases, it was mostly on new issues, which had much higher credit quality that was out there in the market.
It doesn't matter. But it doesn't matter.
Exactly. Right. Any final one? If not, it's lunchtime.
It's Doug Hamilton over there.
Oh, I'm sorry. Please. Yeah. I'm sorry.
Yeah, I'd like to connect some of the discussions we've had here, and some have called the Fed the mother of all GSEs. And one, do you agree with that? And secondly, if you do, does your framework for thinking about GSEs also apply to the Fed, or do you have to modify it in some way because of the unique and special characteristics of the Fed?
We should have gone to lunch. I think that's a great question that I will contemplate and maybe talk about at some future SOMC meeting.
Charlie?
I think it's well, we'll stop there.
Lunch is a good idea.